Well, David Allen from Plato Investment Management joined us for our latest conversation about investment strategy, set against the backdrop of Future Generation's 10th anniversary celebrations. Australia's top fund managers work for Future Generation pro bono, ensuring Aussie investors can gain access to some of the nation's best strategies, such as Plato's long-short global equities fund, and do good at the same time. I caught up with Plato's Dr. David Allen and began by asking a bit more about the investment strategy.
So Plato Global Alpha Fund, we launched it a little bit over 3 years ago, and it's invested in global equities. What's distinctive about the strategy is it's long and short, so we'll identify companies that we think are undervalued, likely to do very well in the next 6 or 12 months, but we're also looking for companies that we see material risks for in the next 6 to 12 months, and we can make alpha for our clients on that side as well.
Yeah, so this is in the higher risk category, is it?
Yeah, in some ways, some people often think long short is equivalent to high risk, but the volatility of the strategy is actually quite modest. The volatility is the same as a Vanguard index tracker with thousands of securities, but we've still managed to outperform the benchmark, which is MSCI World, by over 10% a year. So, having that low risk hasn't been an impediment to generating some great returns for Future Gen and all our clients.
Yeah, we'll get to Future Gen in just a moment. Just to flesh this out a little bit, and forgive my ignorance, when you're running a long-short fund, it's not like half and half, is it? Does the percentage of what you're long on and short on change all the time?
No, that's a very good question. Some strategies are exactly that. They're equally long, equally short. Okay, so they're market neutral strategies, termed as. What we are, though, is we're, for every $100 a client invests with us, we're $150 long. Okay, so 50% more money working for you in our best ideas, but we're also 50% short. So when we do come across a company where we think there's really weak governance or it could be fraud, we can take short positions. And it's actually generated 70% of our outperformance to date has actually been through those short positions.
Interesting. I find it fascinating. I don't think you're going to lift the lid on your entire strategy. However, we are obviously heading toward a new year. We have all the fallout from the United States election to take into consideration. We have, still central bank uncertainty as to the pace and scope of rate cuts going forward and where that neutral rate will actually land. I don't want to put words in your mouth. What are the biggest risks that you see going forward?
Yeah, well, obviously, in the very near future, the US election is the biggest risk. I've got 3 little girls, but other than those keeping me awake at night, it's definitely the US elections. If it's a decisive result one way or the other, I think that's going to be received very well by markets. We saw when Trump was elected and when Biden was elected, the markets went off to the races in both cases. But if there's a highly fractious, contested result, which is certainly possible, if not probable, then markets crave certainty, as you know, and that could spell quite a lot of turbulence over the next month or so. But let's cross our fingers and hope that doesn't happen.
Yeah, I got it. So when we think about where the opportunities lie, I mean, obviously 2024 has been dominated by AI, by big tech.
Yep.
A few concerns about market concentration in the tech names in the US.
Yep.
Are you still seeing opportunity in those growth names?
Yeah, definitely. I think some people like to draw analogies between what we're seeing in markets now and the tech bubble of 20 years ago. But I think the analogy is pretty stretched. Firstly, the valuations, yes, they are expensive at the market level, but they're nothing like what we saw during the GFC. And the companies you referred to, those concentrated names, they are phenomenal companies that are throwing off 40 billion free cash flow a year each. Your names like your Amazons, your Nvidias, your Apples, your Microsoft. So they are fantastic quality companies with growth opportunities as well. I'd also, it's very, very natural to think, market valuations are quite extreme. On our readings, if we look at market valuations of the S&P 500 going back to 1881, they're in the most expensive 3 percentiles. So there's no argument about it. The markets are richly valued. So you think it's almost would be imminent that we can expect some sort of a correction, if you like. But what's interesting is the valuation at the start of the year has a almost zero correlation with the returns you can anticipate over the next 12 months if you actually do the research. So what's intuitive perhaps isn't always borne out by the data. If you have a very long-term horizon, maybe a 10-year horizon, you see that valuations is quite predicted, but over 1 year, it's so noisy. There's so many intervening events like elections and different geopolitical shocks that can muddy the water.
But is it fair to say that you are a believer in the AI thematic, that it is being proven that the tech companies will be able to make money from the investments that they've made already? Not only that, but that will have that the trickle down impact when it comes to productivity?
Yeah, I think so. I think it's going to take longer than people anticipate or people hope, and that's generally the way with new technologies. There's an initial enthusiasm and over exuberance, perhaps, and that's only natural. But over time, I do believe that these technologies are transformational in the same way that the internet was transformational. But it's going to take several years for that to bear fruit.
So now I'll just dig a little bit into geographies, I suppose. I was reading a Franklin Templeton Global CIO survey earlier, and they were pointing to favoring European and emerging market equities over U.S. equities.
Yep.
What do you think?
Yeah, well, definitely from a valuation basis, it's very hard to argue with that. Like, if you look at Tesla, for example, they're trading at a valuation of a PE of around 100. BMW, they just had their brake recall, as you know, they're trading on a forward price earnings multiple of 4.8. So incredibly cheap, but different growth trajectory, sure. But Europe is undoubtedly cheap, and we are a little bit overweight Europe. But we're not massively overweight because valuation, as I was talking about earlier, it's only part of the story. You've got to consider risk, you've got to consider growth, and Europe is definitely, it is more risky, and the growth prospects are more muted than you see in the dynamic US.
Okay, I could talk about this all day, but I also really want to talk about Future Gen. It's their 10th anniversary, as you know. Why do you manage money at Plato Investment Management on behalf of Future Gen pro bono?
Yeah, well, I know that yourself, also do pro bono work for Future Gen, and which I absolutely commend. And it really is an honour. Future Gen's a fantastic organisation that's poured a huge amount into different charities, and it's a huge honour to be requested to do that. I know the managers on the slate are all very, very high quality, so it's nice to be considered in that group. In finance, we are in a very privileged position, and if you do have an opportunity to give back to important causes, then of course we must do it.
And you see value in it at Plato Investment Management?
Yeah, absolutely. You only have to go to the website to see the incredible projects that they work on and contribute to. So it's more than happy to be associated with Future Gen for now, and hopefully long into the future.